There's a certain type of deal that everybody wants to do. It's cool to be creative finance. So like people are chasing that. But recently, even at Squad Up Summit, somebody who's done plenty of creative deals, but also does cash deals, they came up to me and we were talking and I was asking something about creative deals. They said, you know what? All due respect, but F creative because they're complex in the long run. Long term, I can't scale a portfolio of those, whereas I can easily do cash deal after cash deal after cash deal. And I'm like, that's a fair point. Creative is not for everybody. Don't chase the deal just because you need a notch in your belt. Do the right deal.
What is subject to first and foremost?
Well, I'll just preface with this. I think every deal is a sub 2 deal and everybody's been doing sub 2 and they don't even know it this whole time. So let's zoom out a little bit, roll back. If you go back and look at your deed, you'll find that the utility company can come through and dig up your yard and you can't say jack squat about it. You can find that they can drive through your front yard or maybe your backyard. Those are called easements. They are encumbrances to your property and you bought your property subject to those liens or encumbrances or rights of way or whatever. Every house is subject to something when you buy it. And so you can't sue the utility company when they dig up your yard and mess up your grass. Sorry about it. You bought the house subject to that, knowing that the gas company can come dig up your yard or the fiber company or the city, whatever. So considering that every deal is a sub 2 deal, when we understand that concept, well, all we're doing is adding the existing mortgage or some other lien. Now you're buying it subject to the rights of way and all this stuff from the utility company and the terms of the existing mortgage. That's what a sub 2 deal is.
Welcome to another episode of Affordable Housing and Real Estate Investing. Guys, I know I might say I'm excited, but today I'm really excited to bring Caleb Christopher onto the podcast today because when I first joined the sub 2 community with Pace Morby, they were just starting up the transaction coordinating Zooms, and it was just as if someone just pulled back the curtains and just showed how the sausage is made and all the intricacies. Sometimes people talk the talk, but Caleb is the guy, when you want to walk the walk, he's the guy that you want on your team, on your side, being your thought leader and walking through the entire process. So Caleb, welcome to the show, man. How are you doing today?
I'm fantastic. Thank you. That was a great intro. Man, that was a good time of life where I didn't know any more than the other people around me. I just shared what I learned as I went and everybody got to ride along. That was fun.
Man, I mean, that's why you were so authentic. You were being real and you didn't claim to know more than you didn't know. But most importantly, you had the tenacity to figure out the answer. And you were such a problem solver, man. You were coming up with the most creative solutions. And then when you came up with the solutions, you shared this with the world. You put it right on Facebook. And that's what really made you stand out to me personally. And I was like, I can't wait to promote this guy. I can't wait to talk about this guy's business. But more importantly, just share your immense amount of knowledge with the world today, man. So Caleb, I know who you are, but for those that don't know you as well, can you just share a little bit about yourself and maybe how many transactions or properties or deals have you been a part of so far?
Dude, that's a pretty good question. I should put a little dashboard together, a little stats dashboard. No, so Caleb Christopher is just some paperwork nerd. I just like the way, knowing the stuff. I'm just some guy, right? I help you get your deals done. You're the main character of whatever the story is. I run a company called Creative TC. That's not just coordinators, that's consultants, because we help you do better deals and do them ethically. But we focus entirely on creative finance, sub 2, seller finance, contract for deed, land contract, novation, agreement to rehab and sell, put it in a trust, remediation of due on sale clause, like all the things, contract write-ups. Now, I have been a buyer, seller, lender, borrower, underwriter, JV closer, transaction coordinator, and consultant. I've done a flip. I've got several LTRs. I haven't done short-term or midterm rental yet. I've got a bachelor's in cybersecurity and risk management, and that risk management piece is the focus there because my one skill in life is that I ask good questions, and that helps you do better deals.
Wow. Talk about vocabulary just now. If this guy doesn't sound like he's a guy that you want to know and have on your team, see, I make it a habit to always be around people that are smarter than me. And for those folks that see the world of technology changing the landscape, the industry every single day, you're going to want someone with that risk management philosophy, that thought leadership to help you look at a deal from multiple different angles, see where might the holes be? Where are people not being protected? And that's what you want on your team. That's who you want on your team.
Sometimes the best deal is no deal at all.
Oh, so good.
Sometimes. And it feels like I'm blowing up somebody's deal every once in a while, but I'm just asking good questions. And my goal is that people do the right deal and they do it ethically. And sometimes that means they're like, wait, I'm not the right buyer for this, or this deal isn't actually what I thought it was going to be. We need to cancel.
And Kayla, I can't tell you how many times. So, just for a little bit of background, right? Every single day I go live, I underwrite a deal. Sometimes it's a creative finance deal. And so many people have reached out to me and say, man, I'm so glad you actually underwrote that deal because I was about to buy that deal. Now, obviously, this is not investment advice. We're not soliciting any investments on the call, full disclosure. But sometimes people just assume a creative finance deal is a deal. Like, what? That's not even close to being the case. Kayla, I'm sure you've seen this plenty of times. Like, what kind of issues have you come across?
I mean, there's a certain type of deal that everybody wants to do. It's cool to be creative finance. So like people are chasing that. But, recently, even at Squad Up Summit, somebody who's done plenty of creative deals, but also does cash deals, they came up to me and we were talking and I was asking something about creative deals. They said, you know what? All due respect, but F creative because they're complex in the long run. Long term, I can't scale a portfolio of those, whereas I can easily do cash deal after cash deal after cash deal. And I'm like, that's a fair point. Creative is not for everybody. Don't chase the deal just because you need a notch in your belt. Do the right deal.
And Caleb, I can't tell you so the story here is when I joined Sub2, I thought I was going to buy all the creative finance deals in the world, right? You come in here and that's it. And I get that feeling because I talk to so many people, new people come into the community and they're like, oh, it's not as easy as I thought, but they were just talking about some guy or some girl that just got a deal the first week they joined the community. And then you have the comparison. And it's just what I realized is if you understand how to underwrite deals and you learn how to look out for others' best interests, build relationships with other investors and partners, now all of a sudden your menu of the options that's available for deals, it goes beyond just creative deals. Man, you could have bought 10, 20 deals, cash deals, on the market deals, if you just learn how to underwrite correctly and spot them really quickly, instead of waiting, what I did took me a whole year to get my first seller finance deal. And when I realized how long it took, I said, why did I spend a whole year looking for it? Well, if my focus was on just looking for creative finance deals, I blocked out everything else. So lesson learned. So Caleb, let's get a little technical because we just talked a lot about creative finance. Let's kind of set the stage because subject to, sub to, that's the terminology we hear a ton about nowadays.
Yep.
With a technical guy like you, why don't you explain to us what is subject to first and foremost?
Well, when you buy a house, I'll just preface with this. I think every deal is a sub-2 deal and everybody's been doing sub-2 and they don't even know it this whole time. So let's zoom out a little bit, roll back. If you go back and look at your deed, you'll find that the utility company can come through and dig up your yard and you can't say jack squat about it. You can find that they can drive through your front yard or maybe your backyard. Those are called easements. They are encumbrances to your property and you bought your property subject to those liens or encumbrances or rights of way or whatever. Every house is subject to something when you buy it. And so you can't sue the utility company when they dig up your yard and mess up your grass. Sorry about it. You bought the house subject to that, knowing that the gas company can come dig up your yard or the fiber company or the city, whatever. So considering that every deal is a sub-2 deal, when we understand that concept, well, all we're doing is adding the existing mortgage or some other lien. Now you're buying it subject to the rights of way and all this stuff from the utility company and the terms of the existing mortgage. That's what a sub-2 deal is.
Wow, I've never heard that analogy being used before. Yeah, because normally we talk about the deed and the mortgage are two different things. We've heard of the Costco receipt example versus the credit card example.
Yeah.
But now that I think about it, whenever the water company comes here to check on my sewer pipe, they knock on my door, it's like, hey, we're gonna go check on your sewer pipe. And I was like, oh, sewer pipe's on my property, and they're gonna get to it no matter what. So
yeah, you can't kick them off your property. It's not trespassing. They have a right to be there.
Got it. Well, I want to talk about sub-2 from maybe a little bit of an affordable housing strategy. And right now we understand that interest rates are really high and subject to typically might be more attractive because you get to buy a property with the underlying mortgage that might have a lower interest rate. And that's why I really wanted to bring to light or attention on this podcast, because for those folks that are looking to do the right thing, make an impact with their money and their investments, subject to might be a good exit strategy. So Caleb, where have you seen sort of the deal flow for sub-2 deals come from? And then after that, I want to get into like, hey, what are the pros or the cons with subject to transactions so that people can get a good grasp or a good understanding of what it really means to get into a subject to transaction?
That was a 2-part question, maybe a 3-part. Where do I see them coming from? A lot of them are from cash wholesalers who occasionally get a creative deal. A lot of them are from creative focused wholesalers who are targeting low equity, high days on market, things like that, or pre-foreclosure. I try to avoid pre-foreclosure. I try to avoid probate and divorce. Those they get messy. The cancellation rate is pretty high on those and people get disappointed and or they take like twice as many hours. There is a market for it. There's a need for those people and those deals, but I've noticed that they're not profitable for my team. So we've been trying to stay a little bit off of those unless we have to take one of those on. But a lot of times people stumble onto them or they're targeting them directly, and then you can't take down every single deal. So the wholesalers are assigning a sub 2 deal is one of those things. It's kind of it's a gray area. Where's the moral or ethical line of who do you assign to? Do you vet your buyer? Do you purchase on a wraparound mortgage so that you've promised to your seller and you're accountable to them for making sure payments get made so that you then wrap it to your buyer so that then you can still stay in the middle and remain accountable to the person you made a promise to? Like that's the right way to do it. Unless you have a good partnership with somebody and you're assigning to somebody you know who's vetted, who's demonstrated success and reliability, has good credit, assets to back it up. I kind of jumped through a little bit of both questions there.
Dude,
refocus me.
No, I mean, that's why we have you on there. It's because all these thoughts just come through your head and you're like, oh, just that happened, that can happen, that can happen. Well, why do people sell on subject to typically? Because I want to cover some of the pros first.
The actual sellers, you mean?
Yeah, the actual sellers. Because people are probably wondering, why would someone do that? Because the loan stays on their name, right? I'm sure you get those objections all the time.
Oh, yeah, for sure. And I mean, we've got contract write-up service where people bring us these deals that they've negotiated, and we'll run a Q&A session with the realtor, with the seller, with their mom and their cousin and anybody else who's got questions, because this is a legitimate way to do business, but it's not your first strategy. And so when somebody brings one of those to us, we strongly encourage that you have aggressively disqualified a cash offer. The seller's turned it down. The realtor route, the regular MLS listings and offers and things like that aren't working, whether it's priced too high, they have no equity, it's going to cost too much to sell, it won't pass inspection, you name it. And then the third thing to disqualify is keeping it. If they still want to sell after cash realtor and keeping it, now you've got a creative finance deal. And so if you're pushing for a creative finance deal, I'm going to challenge you, did you disqualify cash realtor and keeping it? Because when we start asking these critical questions and make sure they understand the nature of the transaction they're doing, they might back out. And I don't want that to hurt you later on. So disqualify early. And if it falls apart today, it saves you a headache and a big deposit with my team.
And it saves you a ton of time at the same time.
Yeah.
People forget, and I always talk about burnout sometimes, Caleb, because burnout typically comes from doing a ton of work for no results.
Yes.
And if you don't learn how to preserve your energy, get someone like Caleb on your team to help you think through these scenarios and go through that process of disqualifying. Hey, was it cash? Were there no deals? Or does the seller have to come out of pocket in order to sell the property? Like those are all the questions that you need to come up with, because if the deal blows up, you just spent a month, 2 months, 3 months on that deal, and it's going to be super disappointing for yourself. And
maybe you let the seller down too, you know?
Yeah.
Like there's real people's lives involved here. So never forget that.
Absolutely. So Caleb, maybe this is a good time. What is like the top question that you typically get from a seller, whether that's an objection or just a question about the entire process that you might be able to share with the audience today?
When will my loan be paid off?
Oh,
The answer is in due course. We're going to pay the mortgage. And then their follow-up question is, well, how do I get another loan? So we talk about debt to income ratio. And, you know, like if they're willing to wait 12 to 18 months for a refinance or a payoff, then why not 5 or 10 or 25 or 30 years? Because after 1 year of documented payments by another person, it shouldn't affect their debt to income ratio at all. Maybe 25% of the monthly payment, but not if you've got a good underwriter.
and you're able to overcome this by showing that the payments have been serviced by a third-party servicer and the payments have been being paid for by another person. Ideally, that might have been the buyer of the purchase, right?
Yeah. The main elements are that another party has a documented promise to pay what you owe if you're the seller. And so if I'm your buyer, Kent, and you're trying to get another loan, we'll show to your loan officer, hey, here's my promise to pay. It's either a wrap mortgage or it's a promissory note. We have this thing that I created called promise to pay. It's a promissory note for when somebody does a naked sub-2 where they don't do a wraparound mortgage. And that way you at least still have a promissory note that makes me legally obligated to make your payments, so that you can show it to your loan officer and get qualified for that next loan. That loan officer just needs to know, is somebody else accountable for making these payments? Are they making payments with good payment history? Are they credible? So that I can just wipe this off of this person's debt to income ratio and get them a new loan.
Beautifully explained. How about realtors? Because I didn't know you were doing consultative calls and you have realtors on the line and now you have multiple parties on the line. So now it can get a little confusing. How about realtors?
Yeah.
What's the number one question that they typically ask?
It's actually an unasked question, but it has to be addressed every single time. How do I get paid?
Yes, that's so good.
They're looking out for number one, even though their job is to look out for number two. And so I'll try to address it early on a one-on-one call or something like that. Like, now, what have you guys negotiated for pay? Are you taking a full fee? Are you taking a reduced fee? Is it a flat rate? What are you guys doing? Well, I talk to my client first about that because you can't skip that conversation.
And I think that's so important to address up front. Even if you guys are just pitching deals before you might even get Caleb involved, you should help the realtor understand how are they going to put dinner on their tables for their own families. Super important. So I want to talk about other issues that commonly come up. Due on sale. Have you ever come across that issue? Maybe explain what due on sale is first, and then talk a little bit about whether or not you come across any of those issues.
Absolutely. You said you point people to my website. I'm going to plug that one right now, creativetc.io. I'm serious. Go there. I have a services menu, and then down one of them is due on sale. We do due on sale remediation. I have a testimonial from somebody we saved. I've done 6 of these due on sale remediations. And there's like 8 strategies to solve it, okay? But not every one is appropriate for every deal. And so some people say, oh, you just throw it in a land trust and you're good. Well, technically, you come to Mr. Talk Nerdy to me, technically, a trust, Garn St. Germain, does not protect an investor buyer from due on sale. And so even if you put it in a land trust to begin with, the mortgage company can accelerate the mortgage, due on sale, and it's upon you to prove that it was not a violation of the mortgage clause, the due on sale clause in their mortgage.
I love that. At least my goal for this podcast was to help remove some of the fear from folks that are listening. Like, oh, because typically what everybody does is, and it's not a bad thing, they always look for, hey, what can go wrong in a subject to transaction? It sounds too good to be true. Why would someone sell? What happens if X and X happens? Well, what I might recommend is for you guys to work with someone like Caleb and his company. And full disclosure, I get no referral income. I'm not looking for that. I'm simply here looking out for the community, because what's more important to me is that for us to create and solve this affordable housing problem, we need creative strategies to create a better spread, because I'm not naive. Sometimes everybody needs to put food on the table, and there needs to be a little bit of spread, because how else can you incentivize investment into a particular area or a particular niche if you cannot provide some sort of returns? So that's why I want to bring Caleb on the call, because everybody gets so afraid of due on sale. But if you just had someone that went through this before and understand what to do when the time comes about, you might be a little bit less afraid. And now maybe you would be at least willing to take the first step to at least pitch a creative deal if you cannot get a good enough deal.
Yeah. Due on sale. I've been there. I've done that. We had one called on one of ours, and it was the seller said the wrong thing to the bank, or called the bank and asked a question that led to a conversation that busted it up. And I've dealt with 5 others, and we've been able to resolve it every time except one. And that was where the seller got uncooperative over $1,000 dispute. And so guess who still hasn't accelerated months and months later? The bank, because they're getting paid. And what are they going to do? Now, I have seen banks shut down the mortgage portal and refuse payment. They really do intend to go through with the whole thing. And okay, fine. All right, we got to solve it. We got to fix it. But most of the time, we can get it resolved in 1 to 2 weeks with some paperwork, do a little paperwork shuffle, show the bank what they need to see, tell them to shut up and leave us alone, and then you're good. And if I can't say worst case, but if it gets pretty bad, you guys, you ever play checkers where you've got somebody cornered and it's just this move, this move, this move, this move, right? It's that. We can do that with the bank. Deed back, deed back, deed back. And they accelerate, unaccelerate, accelerate, unaccelerate. They're really going to have to sue you in court and have a judge say, all right, you guys are being unreasonable. I award whatever. And the likelihood of that's so low. Like, I'm pretty cavalier about it because we've dealt with it before. It's not too bad.
So it's solvable. And I really hope you can understand that. It's solvable.
Yes.
You got someone on your side. Maybe one of the things, because I've heard insurance typically triggers the due on sale a lot. What is the correct way to go about handling the insurance policy being transferred from the house that you might be buying subject to the new owner, which might be on a landlord policy, right? So different products.
I've gotten the runaround from several insurance companies. The most appropriate guidance that I've got, and I'm not an attorney and I'm not a CPA and blah, 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 okay? The most appropriate guidance I've seen and consistent is that the person with an insurable interest in the property has to have a policy. So if your LLC bought it, your LLC has the insurable interest, whoever has the deed. Therefore, the primary policyholder needs to be that entity. You can add other people as additional insured, and it's generally accepted as a best practice that your seller or whoever's the borrower be added as an additional insured unless and until their mortgage is paid off. But that's when the deed transfers. In a contract for deed, for example, the deed does not transfer from them to you. And so the actual appropriate policy in almost every case, there are some agents who will disagree and you just have to escalate to their underwriters. The actual correct policy is going to be a landlord policy in the name of the seller who still holds legal title. And then the buyer has to get a renter/contents policy. So it's a dwelling policy over here and a contents policy over here. And some buyers, if you're trying to wrap to a homeowner occupant, some of those people freak out. They're like, I'm not a renter though. And they feel like it's a downgrade. And we're like, look, it's just a technical game that these paperwork people have to play. And so you get a renter's policy to cover your stuff, but this person got the policy to cover the building and the proceeds are for your benefit. Relax a little bit.
Just for the people to make sure that they're asking for the right things. Does that require like a power of attorney that the buyer needs to get in place? Okay, I got it.
Now, if I'm the middleman, if it's an A to B that I bought and then I sell to party C, an owner occupant, I'm not giving party C a power of attorney. I'm getting paid to stay in the middle and be a manager. So I have to be the power of attorney for them, for the seller. I want to make sure that I have full control and I'm in charge of things. Never forget this, though. A power of attorney is a voluntary arrangement which can be revoked at any time and also expires when the person's life expires. If they're dead, they can't act. Therefore, you cannot use a power of attorney to act on behalf of a dead person.
Oh, that's so good.
The power of attorney is not a magic bullet. It's very helpful, but it is not required and it's not the magic bullet.
That is so important. And I think that's why, again, I always stress to have someone like Caleb and his team on your side, because these little nuances, they might save you hours, if not weeks of pain and trying to figure out and trying to search on Facebook for an answer. Just hire the right people, and you don't have to be the expert in everything. Work with someone that has actually been through it and see the different issues and already had the 10, 50, hundreds of conversations with insurance folks, mortgage companies, etc., to actually go through the process with them.
Would it be valuable if I offered to do that on behalf of people, set up the insurance? I've been holding off.
Oh, yeah. I mean, I've gone through one transaction myself and I had someone set up servicing for me, had someone set up insurance for me at the same time too. So at the end of the day, when I realized like what my superpower is attracting deal flow and helping underwrite deals and educating my partners on the deals, like that already takes up all the time. For me to do anything else, it just creates this drain on your energy, right? You ever feel something like tugging at you when you're doing something that you don't want to do? It's a huge energy drain.
Well, that's what's happening on the other side. You know what I'm afraid of is if I did a perfect job and still a due on sale came up and it wasn't my fault, guess who's going to get blamed? And that's why I've been holding back, you know, that's why I haven't done that post-closing service. I don't want to do that on behalf of people and then I can still do a perfect job. There's no way they can tell I did a perfect job. And it could be somebody else's decision that causes the due on sale completely outside of my control. And I don't want a 1-star review for something I have no control over.
And I feel like that's why you got to be selective, because if someone does not acknowledge, it's kind of like when you guys go through the sub 2 addendums and you make everybody, or the seller at least, like acknowledge all these things on when a due on sale might be closed. And hey, just to be super clear, the loan is staying in your name, Mr. Seller. Like these are all the things that you should be setting aside for your clients, right? I'm sure you might do something of that realm, but it's just got to set the right expectation. With creativity comes education, right? If people go to school and they sit in a class, doesn't mean they learn everything in class. So that's what I'm getting at. Just because you do everything right, just because you teach everything right, even doesn't mean everyone in your class is going to get 100 on their tests. And maybe that's a good analogy for you to use.
I think I'm working on coming up with a product, a due on sale guarantee. And so if I can offer a due on sale guarantee, then I'll do post-closing services. Wow. I'm working on that paperwork actually this week.
Dude, I love that. I can't wait to hear about that after you actually put it out there. So, well, we just talked a little bit about your post-closing service that you might be working for. Caleb, help educate people, because people understand what realtors are. People understand what title companies do, escrow agents, blah, blah, blah. But what role does a transaction coordinator really play? And maybe we'll just speak it from your company's angle. Why does someone need a transaction coordinator? And what do you guys guys do?
Yeah, absolutely. So a coordinator can range from just being an administrative assistant, like answering emails, keeping schedules on track, managing checklists, all the way up to basically project management for your deal. Okay. And everybody's got their own flavor and price point and all those different pieces. For me, Creative TC stands for Creative Transaction Consultants. We are going to be premier. We know the most. We ask the best questions. And our goal is to help you do the right deal, the best way, and ethically. We want you to make informed decisions. And so my team comes in at a premium price point, maximum service. My team cannot handle a stink ton of transactions per person because we're giving enough training and focus. And what I found is clients will use us 5 to 10 times and they've learned enough. Then they usually go try to roll their own or use a different TC. And now that they know the questions to ask, they do just fine. Honestly.
Wow, I love that. Well, I always pride myself on looking for the A players, looking for the all-stars. That's just where I want to work with. Because at the end of the day, like if you think about the most successful people in the world, I don't know, the wealthiest, I don't know, Elon Musk or Jeff Bezos, who cares? But if you think about it, they're just a leader of team builders because they're just hiring team builders and those people are building other team builders. And that's what allows these companies to become billion-dollar companies. And if you don't have those A players, you will never be able to get to the level you want to get to. And I'm sure for most folks listening right now, you're either a blend of single family investors, multifamily investors, or ground up construction developers. But for you to get to that level, you have to be willing to let go of certain items. And for you to be able to let go of certain items, you got to be able to trust that person to think about questions that you might not have even thought of. And that's why I brought Caleb on here, because just with the amount of knowledge she shared so far, like I'm blown away.
When I recruit people, we're hiring directly, right? We're not using VAs. We hire and recruit on LinkedIn and Indeed and other places like that. We interviewed, how many interviews? Like 150 interviews, 900 applicants, and we hired 24 people. Like it was 2.5 months solid of reviewing candidates and going through and picking and selecting. And I wanted to buy an employee, you pay for their time and their experience. And I wanted to buy experience that was diverse. So we hired attorneys. We hired real estate agents. We hired property managers. We hired people who've never touched real estate at all. And they've worked in other service industries because I wanted all those perspectives to come in and shape our base of knowledge to provide services.
Wow, that's what makes you a great leader, man. A leader that's open to embracing multiple opinions and perspective. That's what leads you to a high-performing team. So I really commend you on that, Caleb. That's really amazing.
Thank you.
Well, let's get into a little bit more technical stuff because I want to make sure I cover a few more creative finance options because we talked about sub 2. That's a really big one. How about a seller finance deal? Tell us a little bit about that. And then afterwards, I'm going to move to wraps.
So seller finance is a broad category. Inside of seller finance, when you say it, most people think of you own the house free and clear and you finance it to me. That's seller finance traditionally, the way people think of it. But technically, sub 2 is a form of seller finance. I'm selling it on terms to you and giving you these terms, whether I'm mirroring the exact underlying mortgage or I'm adding a little bit on top, whether balance or interest rate, or I sell it on a contract for deed or a land contract or any of these things. They're all subtypes of seller finance. And so you can work that in. But one of the main points I have to make to a lot of newer people is, hey, your entry strategy determines your available exit strategies. And when you allow the seller to push for a balloon, and I kind of touched on this earlier, like if they're okay waiting 1 year, why not 30, right? The only time that loan being open that is really going to affect the seller, the sub 2 loan, is really for the first year while they're waiting to get their full DTI reduction. After that, why do they care? They have a trust issue with you. That's the problem. And you need to overcome that. You have a credibility issue. So stop doing balloons if at all possible, because when you have a balloon, guess what? I can no longer, if you're trying to assign that deal to me as an investor, I can't take it down and then sell it on a wraparound financing or contract for deed to an owner occupant with a balloon because of either RESPA or Dodd-Frank or a combination thereof.
Man, that's such a great explanation because I think people just overlook these details. Because they're like, I just got to close the deal. But then you forget about the downstream impacts, right? All the time.
You have to think about your buyer. And in some cases, that means in creative deals, actually a lot of cases, that means you have to underwrite for your buyer's profit. And that means underwriting it for their end buyer, their tenant buyer, whoever that's going to be. So if I understand I'm going to assign this and they're going to do something else with it, it has to be profitable all the way down there.
Oh, that's so good. How about a wrap, Caleb? What is a wrap? That's such a common term that we've seen. What is a wrap, and when you see people doing it, or why might they be doing it?
Sure. A wrap is, again, it's a subcategory of seller financing. But a wrap is when you create a new mortgage or deed of trust, I'll use them interchangeably, that wraps around an existing debt, a lien, an encumbrance, whether it's a water softener lien or a court judgment or whatever, you wrap around it and you incorporate the terms of the first mortgage by reference. And so, let me see if I can find, I had the 4 rules of wraps on a webinar I just gave yesterday.
Oh, that'll be good.
Watch this. Watch this. Let me move my head out of the way and move this thing over here. Can we see this? Yeah, there we go.
And just for the people listening on audio, make sure you say it out loud for them.
Yeah. So the 4 rules of wraps. The timeline, the term of the loan, it must be longer than the existing loan. So you can't do a wrap that has 15 years on it when your underlying debt goes for 30 or has 28 years left. You can't be doing that. Now, if the pay down schedule works, then you're fine. But you can never, that brings me to the next one, the balance must be the same or larger by comparison. You can't wrap $220,000 when you have an underlying mortgage of $225,000. You can't do that. Okay. In all aspects, basically, it just has to be bigger. It has to accommodate the existing loan. Number 3, the terms. The terms must be the same or stricter. Number 4, monthly payment. It should be the same or larger. So the 4 rules again. Timeline. The wrap must be the same distance or same length or longer than the term of the existing loan. The balance must be the same or larger. You just can't be more loose with the wrap than the underlying terms and conditions. That's the main piece.
And I love that you brought up those 4 rules because that's such a basic foundation for you guys to analyze a deal and look at a deal. Because so often I hear in sub 2, people might go, oh, it's not a deal, just wrap it. And it's
that's not a magic pill.
Wrap it. It just, I was like, why? And I get it, right? For guys and girls that are listening, people will say, hey, they're providing affordable housing options because they say, hey, for folks that might have never been able to qualify for traditional loan, you are helping them buy a home by providing a wrap because now you are becoming the bank essentially to these buyers and they can actually get a loan. Otherwise, they might have to buy a whole property all cash and that's not necessarily affordable. What issues have you seen come across for wraps, Caleb?
Well, speaking with regard to affordable housing, you know what I'm not seeing? Wraps with a $4,500 payment. You can't just take anything and say, oh, I'll just mark it up to 10% and it's a wrap. That's not real life. Will you back off of that concept, guys? It has to be affordable housing, whether it's for affordable housing for people who are disadvantaged or just generally, if you're doing a wrap, it has to be affordable to the person. And so I'm not seeing wraps payments exceeding $3,600, $3,700. And that's on the high side, and that's a high risk transaction. So if you're buying something that's got a $3,300 payment, guess what? Probably not a deal. Can I just say that? Okay, so you need to work backwards from your person's affordability. If you know that your average person's going to be able to afford, or maybe your stretch person, your stretch goal person is going to be able to afford $3,500 a month, then you can take whatever your entry monthly payment is and mark it up and then just play with the interest rate, work backwards from what they can afford and build a wrap mortgage. That's the underwriting, the math behind the deal, build that new mortgage. So you're taking it from a 4%, maybe to a 6%. Oh, I want to sell at 10. Sorry. Nobody can afford that. Take your 4% mortgage and mark it up to whatever it takes to get it to where your buyer can actually afford that payment. That's principal, interest, taxes, insurance, and HOA. Factor all of those in and do not deceive people when you say, oh, the monthly payment is $3,300. Okay, is that before the extra $800 in taxes and insurance? Don't be a dirtbag.
And I'm so glad.
I got some opinions.
You just schooled everybody on that because I mean, that's so important, man. Because I'm so happy you emphasized it from the person, or maybe we'll call it the customer, right? Or the wrap buyer, whatever you want to call it. Because you emphasize it from their perspective. Guys, if you think about it, right? There's a reason why all these underwriting standards were put into place. It's because 1, you don't want to give up bad loans that are going to default. And 2, if you, like Caleb said, put a mortgage statement of $4,500, man, the person probably has to make at least 3 times that for them to be sustainable. What kind of position would you be putting that homeowner in if more than half of their payments is all going towards the house? Think about what money do they have left for food? What money do they have left for, I don't know, taking the kids out to the amusement park every once in a while? Just think about that. Please, please, please think that through, because you might think of it as affordable housing. You might think, but just think about the life. Think about if you were in their shoes, like how might you react if that's how much of your monthly income that you were allocating towards housing. So please think that through.
Yep. And be ready to be able to carry a payment. If you're going to stand in the middle, you darn right well, you better have some savings. And when you close on it, you're going to carry that thing for 3 to 6 or 7 months. And if you can't afford the mortgage payment for that long as holding costs, that's not a deal for you. It takes a while to sell these wraps.
Thank you, Caleb. Like some people even forget about that.
They look at the cash to close and not the entry fee.
I think in this industry, we emphasize so often buying properties with no money down. But that does not necessarily mean you shouldn't have any money in your... Exactly. Thank you so much, Caleb. This is why I brought you on a podcast.
It's irresponsible to buy a property with $0 in your pocket. It's cool to do zero money down, but that still doesn't mean you have zero in your bank account.
Thank you, man. Because you're putting yourself and your sellers and your buyers all in bad positions for financial stress that you should have never been in the first place, to be quite honest with you. That's how people lose their shirts all the time. Yep. Well, one more item I want to talk about, lease options. What are lease options? Because we've also heard of people talking about, hey, how do I promote more home ownership in the affordable housing world, right? How do I turn these people into homeowners? How do I seller finance it back to them? Like, what can we do to provide more home ownership opportunities? Because that's sort of the American dream for some folks. Can you explain a little bit about lease options and what they are?
Absolutely. I actually love lease options. I don't love rent to own. There is a difference. Rent to own implies that your payments are building equity in the property. And if I have to kick you out and you're my tenant, I have to pay back your equity when I kick you out. Danger. Do a lease with an option to purchase. And we call it a lease option, but there's a lease and there's an option. And as long as you're current on your lease, your option is valid for the 1 year, 3 years, 5 years, whatever. And so what happens is you find somebody who wants ownership and you let them rent the property while they build their credit, while they build their savings, whatever that is. That tends to be a good tenant because they care. They think they're going to have this house. They're going to take care of it better than the average tenant statistically. And what they do is they also pay a fee, a one-time non-refundable fee for the option to purchase. You can give them the option to purchase traditionally with bank financing or cash, or you can give them the option to purchase on seller financing or sub two as well. The terms of that option are up to you. And so I always give this example. I've got a property that's walking distance and line of sight to an elementary school. That property is going to be worth a lot more than the regular monthly rent rate to a family that wants to own, who only has one car and 3 kids. If the rent is $2,000 a month on average for that property, they might be willing to pay $2,300 to live there and to have the option to buy. It's quite possible.
What are some of the terms that you have seen? Like, how long are these options typically going for? And you just provide a great example of how you can charge a little bit above market rate so you can get a little bit extra cash flow, but then that lets you make your money a little bit earlier, but then you get to exit and also provide a home ownership opportunity for other folks. What sort of terms have you seen in the industry, Caleb?
I have seen, actually, let me come back to that. If you get stuck in a deal that has a balloon, that's a great way to handle it. If you've got a 5-year balloon and you set your option period to be 6 months before that balloon, that gives you enough time to make them poop or get off the pot. And if they don't, then you can sell it on the market or refinance and hit your balloon date. So the lease option is a great way to handle that. The types of terms that I'm seeing in lease options are going to be, well, it's a lease, right? The lease monthly payment is a little bit higher because you're giving them a privilege. And so they have to pay a little bit extra for that. You don't have to do that, but that's typically what I see. The lease is just a lease otherwise. The option is connected or references the lease and vice versa. And the option has different terms like if you buy within the first 12 months, your purchase price is going to be $225,000. If it's between 12 and 24 months, then the price goes up to $235,000 and so on. And every year you take, so you can do the stair-stepped price. You can just have a fixed rate price, whatever you want to do there, because it's a bit of a gamble for the buyer and for the seller. And if the market drops and it's not worth what the strike price is that you have on the paper, then they just don't exercise their option. They can pay for an extension. There's so many options. It's very flexible on how you handle this stuff. The length of term depends on what you guys are doing. Could be 1, 2, 3, 5 years. I really don't see more than 5 years on an option. And then the price of the option also has to be reasonable and fair. So a $50,000 option fee is not a down payment, by the way. A $50,000 option fee for a 1-year option, probably not a fit. I'm guessing it's going to be less than $10,000 is a fair option fee. And you'd be hard pressed to really hit 10,000 or higher unless people were bidding on it.
Wow. I'm so glad you went through those terms because I think you just highlighted how flexible it can be, right? Because everybody is thinking, well, if I give them an option in 5 years, doubles in price, what happens? Well, you can do a little stair-stepping strategy, just like what Caleb talked about, to protect your quote unquote downside. But I really wanted to expose that strategy because look, affordable housing is such a big problem. And there's plenty of opportunities in the world for us to solve this problem, but it also requires a lot of tenacity, a lot of effort, a lot of volume, and a lot of creativity from a lot of people. And that's the only way we're going to solve this issue. So when you hear about these options, these lease options specifically, now you have another way to think about, hey, if I could just make an impact on one family or 5 families, well, here's a really good way you can do it. And you will probably change the lives of that family forever, for that family, the parents and children growing up in there. Just like what Caleb was saying. You have a house down the street, 1 block from elementary school. That's amazing. That takes away so much stress from the family, just by not having to drive to their kids to school every day. And now all of a sudden, they might be able to go to work a little bit easier, right? All these things factor into the quality of life of a family. And who knows, one of those kids might grow up to be like Caleb and helping a ton more people, helping another 1,000 people getting creative financial transactions together. And that's how we solve this problem. So, Caleb, this is the question I kind of ask everybody on the podcast. And the reason I ask this is just because I believe we are going to solve this affordable housing problem. No one has really solved it yet, in my opinion. But I think it's just about collecting enough pieces to the puzzle, and eventually we'll get all the pieces. Even if it's not in our lifetime, we can pass on the pieces to the next generation. So I'd love to understand from you, like, hey, why do you think affordable housing, particularly the lack of supply of affordable housing, is so hard to solve for?
It's a really good question. I think a slight shortage is an indication of a healthy economy. I think this problem should exist to some degree. It sucks if you're the one that's facing the problem, but it's also one of those things that lights a fire under people's butt to go work 2 jobs and save up, or stop paying for Netflix and Disney Plus and everything else. I think largely there's a lot of mismanagement, and people entertain themselves to numb themselves from where they're at economically or whatever situation their life is in. But sucky situations should continue to suck so as to drive people to action, to get out of it. There's a place for charity, and I absolutely support that. But I think, we're solving affordable housing for a profit because there's a problem. If there's no problem, nobody's going to be here helping. So there's always going to be this disparity, and people there like you and me to bridge the gap by offering lease options. And that's something that helps us feel good because we're giving people a chance to step up, and we're supporting our own families by doing it.
Man, I really love your thought process behind that, Caleb, because it's such a massive problem. And the only way we can get more people involved. And I think I really liked your thought of, hey, you have to have a little bit of pain, because the only way people will change is if you have pain or the fear of future pain. And if you don't have any pain, everybody kind of just stays still. And the fear of not being able to do these transactions correctly and properly with the right guidance is why we had you on this podcast, Caleb, because I really wanted people to learn from you and feel a little bit less afraid, so that they don't feel like they're on an island by themselves when they're going through these transactions, so that they can have someone like you. So for that, Caleb, man, I'm so glad you came onto this podcast today. I'm so grateful for people like you, because without people like you with kind hearts, man, I don't know what kind of world we'd be living in. And that's certainly a world that I wouldn't want my kid growing up in. So for that, thank you so much for coming onto the podcast, Caleb. I appreciate you so much, man.
Thank you.
Caleb, for people that want to find out more about you, let's make sure we plug your website one more time. And where can people follow you?
CreativeTC.io is my company. You can book a free call anytime. That's my call to action. Any creative finance question you've got, we got free inbound 15-minute chats. So grab a slot, talk to somebody, ask your questions, and let's see if we can get you a deal done. That said, I can also be found on Instagram, FCalebChristopher. Literally the letter F, that's Frederick's my first name. So Instagram, FCalebChristopher, all one. And then YouTube, Caleb Christopher himself. And I'm very interested this year in speaking at more and more events. So if you've got a RIA, if you've got a podcast, if you know somebody, put them in touch with me. I want to come speak at your event.
All right, guys. Make sure you guys check out his website. Make sure you follow him on Instagram, and the massive amount of content that he already has available for free on YouTube. We'll make sure we put the show links down below. And if you guys have any more questions for Caleb, leave them in the comments, because if we get enough questions, I'm going to try to bring Caleb back onto the podcast again, and we can address your questions right up front, right based on your feedback. And we're always looking for ways to improve. So guys, thank you so much for tuning into the podcast today. And Caleb, can't wait to bring you back on soon, man.
Thanks.
All right. And we are out.